Vanakkam, Namaskar, and warm season's greeting from the fixed income desk of Sundaram Mutual. At this point in time, a fixed income investor has been asking that has the normalization begun or how high the rates would be looking to rise. Both these questions are difficult to answer, but what we can say right now is that the COVID infections have started falling, the vaccination programs have picked up across economies, and this has had a salutary effect on the economic well-being of the countries. This is something which has been recognized by the central bankers and they have embarked on removal of excess liquidity in the system. Recently, the Federal Open Market Committee decided to start tapering the liquidity measures which they had taken during the pandemic time by 15 billion each month, 10 billion in treasury securities and 5 billion in agency securities. Similarly, in India, the RBI has stopped the GSEP program, GSEC acquisition program, and they've also started simultaneously absorbing liquidity from the system at higher rates through the VRRR auction, variable reverse repo rate auctions. We have consistently seen the VRRR auction cutoffs at higher rates towards the repo rate, and weighted average rate is continuously going up. It has been the cutoffs are very close to the repo rate of 4%, and the weighted average rates also have been rising almost about 380, 390 levels. This has also had an impact on the treasury bill cutoff yields, and 3-month treasury bill cutoff yield has had risen to almost 370 and then has come down to about 354. But the 6-month and the 1 year is still ruling at a higher level. The 1 year treasury bill has cut off at 406 level, while the 6-month has cut off at 382, which basically means that market is anticipating RBI to act on the reverse repo in the coming policies. So as the reverse repo rises, the money market bucket is likely to be priced at a higher rate. RBI and the Monetary Policy Committee both have an intention to keep longer rates anchored and durable as long as possible. So this is something which they think is important to ascertain the cost of capital for anybody putting up a project, and that is the thought process behind this. Having said that, it will be a function of the global interest rate environment and the inflation, how it pans out. What we can clearly see is that the infection rates have been going down. On the COVID infection rates have been going down. Vaccination programs have picked up, which basically has resulted in higher frequency indicators looking up. And these high frequency indicators, right away from PMI numbers, both PMI manufacturing and PMI services have been over 50 for some time now. And we have seen the PMI services hit a decadal high. This has been largely due to the pent-up demand in the contact services industry, and this is likely to continue for some time. And as soon as it moderates, we expect it to remain over 50 over the coming months. PMI being a sequential number. Also, the GST collections have been robust. Government's overall revenue collections have been robust, and this has resulted in government taking a decision to cut the excise duty by 10 rupees on diesel and 5 rupees on petrol. This has been taken up by most of the states as well, and they have cut the VAT rates in their respective states. This will have a salutary impact on inflation, but overall it will have a negative impact on the fiscal. Despite the fact that this will have a negative impact on the fiscal, this has been adjusted by and far because of the better economic performance of the economy. This is something which is driving the government to take certain decisions In fact, the budgeted vaccination program of 35,000 crores is also likely to overshoot. It's very difficult to say what exactly would the amount would be, but this could be an easy overshoot of about 10,000 odd crores. So all these things should buffer in, and the likely fiscal deficit should be close to what has been budgeted as the spending picks up, which basically means the government is not likely to borrow less than what they have indicated. And this is likely to put pressure on the yields, particularly in a backdrop when the winding down on liquidity is happening, because the change in liquidity is negative as of now, which basically means that overall liquidity is there, and quite a bit of liquidity is there. Right now, the net durable liquidity in the system is close to about 12 lakh odd crores. But what also we have been witnessing, the trade deficit has been rising. This is in back of X gold and X oil. Despite that, it is high, which also is an indication that the economy is opening up and picking up. So normal import demand is coming back, which is good for the economy. But having said that, the prognosis of a current account being about 1% of GDP may not turn out to be true, and it could, if this oil price remains at the current levels, there is a likelihood that the um, current account deficit could be over 1%. It could be about 1.5 or maybe 1.6%, depending on how the energy prices shape up. India's import dependence on energy is something which will drive this forward, and the surplus which we were looking going forward could turn to probably a negligible surplus or a deficit as well, which basically means India might need to dip into the reserves. So that is something which we need to be cognizant of, particularly in the direction where the economy is headed. Having said that, probably we have seen the best of the rates in terms of the lower end, and we should prepare ourselves for rates rising. The best case scenario would be that RBI would like it to happen gradually over a period of time without any knee-jerk reaction, and that's what they have prepared the economy for. In case there is any other uh, unforeseen shock, which will only probably result in a knee-jerk reaction. Having said that, clearly the supply disruptions are negative for inflation, and that supply disruption, if it keeps on and doesn't ease off over a period of time, this will have a negative impact in terms of the headline inflation number. Whether it is a chip shortage or whether it is the energy shortage, all of these things will feed into the inflation number over a period of time. So that is something which we need to be cognizant of, and eventually that will be what will feed into the rates. For an investor, the strategy should be to remain invested in moderate duration products depending on their investment horizon. If they do not have a long investment horizon, they have investment horizons which are very short in nature. They should continue in liquid and overnight or ultra short kind of category, which is basically any investment horizon 3 months or less. But anybody having at least an investment horizon of 9 months to 12 months to maybe 18 months can look at products like short-term income fund, actively managed strategies like short-term income fund, roll down strategies like some which are available right away in a duration bucket of about 2 years, and this which basically means that over the next 9 to 12 months the residual risk reduces by 9 to 12 months, which is about a year in a 2 year kind of a product. And this is something which we are talking to our clients, particularly from a perspective that the MTM losses could be there over a short horizon, and typically the rate cycle or the rate discounting cycle happens over a short period of time. That's what we have seen over the cycles, and then the pause game starts. So from that perspective, and particularly also at this point in time, remaining, if you have a longer horizon, if you remain invested in the shorter end of the curve, The steepness in the curve or the spread between the overnight and 1 and 2 year is quite steep, and that gives you the margin of safety. Because of that, it is advisable that if you have a longer investment horizon, you should remain invested in lower duration products like ultra short, low duration, depending on your risk appetite, and do not over think and invest only in shortest duration product like overnight and liquid, where the duration is too low and it will be anchored to the reverse repo in a high liquidity scenario, or to the repo in case the liquidity becomes neutral, which is very unlikely scenario in the near term. Most likely we will find liquidity to be ample in the system, because we have been witnessing quite a bit of flows into the system, and the credit offtake has been very low. This credit offtake, until unless it picks up, then only some amount of liquidity drain could happen. And at this current level of about 6.8% of credit growth, very unlikely that liquidity will be drained at a faster pace. So, bearing all these things in mind, we suggest a moderate duration strategy, and remain invested in lower duration buckets, particularly for investors who have short duration investment horizons. Investors who have long duration horizon, they can take every uptick opportunity, and put monies in longer duration products, um, which are available, depending on again their risk appetite and their investment horizon. Clearly, what we also see is that with the inflation targeting framework being present in India now since 2016, very unlikely that the terminal repo rate will be as high as 8% or 7.5%, which we had seen earlier, because the inflation targeting framework targets 4% and has a band of 2 to 6%. So, in our opinion, the terminal repo rate probably has come down to about 5.5 to 6% levels. So probably that could be where the repo rate could become kind of peaking out uh, at any given point in time. So having said that, I think a strategy for an investor at this point in time is a moderate duration strategy. Thanks a lot. Take care and stay safe.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.